Hello, welcome to Capital Sensei. Today, we're going to dive deep into a powerful investment strategy known as the Acquirer'S multiple. We'll explore this concept, popularized by investor and author Tobias Carlisle, which provides a framework for finding deeply undervalued companies. We'll break down its core components, like enterprise value and operating earnings, and understand why this method might just be superior to the common metrics most people use. Whenever we can, we try to answer questions left in the comments. Learning about finance and investing is a journey, and nobody has all the answers right away. So please, feel free to share your own questions, your experiences, or even your doubts in the comments below. Creating a community where we can all learn from each other is one of the best ways to grow as investors. All right, let's get started. If you've ever dipped your toes into the world of investing, you've almost certainly heard of the price-to-earnings ratio, or the PE ratio. It's the most common yardstick people use to figure out if a stock is cheap or expensive. You take the company's stock price and divide it by its earnings per share. A low number, say 10, is supposedly cheap, and a high number, like 40, is considered expensive. It seems simple and intuitive, right? Well, the problem is, it can be dangerously misleading. Imagine you're looking at two potential employees for a job. Candidate A tells you they have an income of $100,000 a year. Candidate B says their income is $80,000 a year. On the surface, candidate A looks better off. But what if you dug a little deeper and found out candidate A has $300,000 in high-interest credit card debt and a massive mortgage, while candidate B is completely debt-free? Suddenly, that $80,000 income looks a lot more solid. The PE ratio is like only looking at the income without checking the debt. It completely ignores a company's balance sheet. This is where the Acquirer'S multiple comes in. It was designed to fix this exact problem. The name itself gives you a huge clue about the philosophy behind it. It's about thinking like an acquirer, someone who is looking to buy the entire company outright, not just a few shares. Think of a private equity firm or a competitor looking to make a takeover offer. What would they really care about? They'd care about the total price to own the whole thing and how much cash the actual business operations can generate to pay them back. So, how do we calculate this superior metric? It's a simple formula: enterprise value divided by operating earnings. Now, I know those terms might sound a bit jargony, but stick with me. They're actually very simple concepts when you break them down. And understanding them is the key to unlocking this whole strategy. Let's tackle the first part: enterprise value. Enterprise value, or EV, is the true takeover price of a company. It's what it would actually cost to buy every single piece of it. The formula is the company's market capitalization, plus its total debt, minus its cash and cash equivalents. Let's unpack that. Market capitalization is the easy part. It's just the stock price multiplied by the number of shares. It's the sticker price you see on the screen. But as our acquirer, we know that if we buy the company, we also inherit all of its debts. The banks don't just forgive the loans because the company has a new owner. So we have to add the total debt to the price tag. This includes long-term bank loans, bonds, and any other obligations the company has. This gives us a much more realistic picture of the total cost. However, there's a flip side. When we buy the company, we also get all the cash it has sitting in its bank accounts. It's like buying a used car and finding a forgotten envelope full of $100 bills in the glove compartment. That cash is now ours, and it effectively reduces the net price we paid for the car. So we subtract the company's cash from the total. The final number we get, market cap plus debt minus cash, is the enterprise value. It's the real, all-in cost of acquiring the business, Let's use another analogy to make this crystal clear. Imagine you're buying a house for $500,000. That's the market cap. But the house has an outstanding $200,000 lien from a contractor that you will now be responsible for paying. That's the debt. So your real cost is now $700,000. But during the inspection, you discover a hidden safe in the basement with $50,000 in cash. That's the company's cash. So your true all-in cost for the house is $500,000 plus $200,000 minus $50,000, which equals $650,000. That's the enterprise value of your new house. Now for the second part of our formula, operating earnings. This is the muscle of the business. While the PE ratio uses net income or the bottom line profit, the acquirer's multiple uses something called operating earnings, which is often represented as EBIT or earnings before interest and taxes. Why the difference? Because net income can be easily manipulated. Think about it. Net income is what's left after you subtract interest payments on debt and the company's tax bill. A company with very little debt will have low interest payments, making its net income look higher. A company that uses clever accounting and tax loopholes might pay a very low tax rate, also boosting its net income. These things don't tell you much about the core health of the actual business operations. Operating earnings, or EBIT, strips all of that away. It shows you how much profit the company's core business is generating before you account for how it's financed or what its tax strategy is. It's a much cleaner, more honest look at profitability. It answers the fundamental question: is this company good at its primary business, whether that's selling software, making cars, or brewing coffee? Imagine two identical pizza parlors side by side, both selling the exact same number of pizzas for the same price. They both generate $100,000 in profit from their operations. This is their operating earnings. But Tony, the owner of the first parlor, financed his ovens with a high-interest loan, and Vinny, the owner of the second, used his own cash. After paying his hefty interest bill, Tony's net income is only $50,000. Vinny's is $100,000. The PE ratio would make Vinny's parlor look twice as profitable, but in reality, their core pizza-making businesses are equally strong. EBIT lets you see that. So now, we have our two pieces: enterprise value, which is the true takeover price, and operating earnings, which is the true operational profit. The acquirer's multiple is simply enterprise value divided by operating earnings. A low number here is what we are looking for. It means we are paying a very low price for every dollar of core profit the business generates. An acquirer's multiple of, say, 6 means that for every $6 we pay for the entire business, we get $1 of pre-tax, pre-interest earnings back each year. That's a fantastic return. This is a much more robust way to find cheap stocks. You could have two companies with the same PE ratio of 15, but company A is loaded with debt, giving it a high enterprise value and an acquirer's multiple of 20. Company B has no debt and a pile of cash, giving it a low enterprise value and an acquirer's multiple of just 8. The acquirer's multiple immediately shows you which one is the real bargain. You're getting way more operational bang for your buck with Company B. But this begs the question, why does buying cheap stuff even work in the first place? The answer lies in one of the most powerful forces in finance and in life: mean reversion. This is the simple, statistical tendency for things to revert to their long-term average. A baseball player on an insane hitting streak will eventually cool off and return to his career batting average. A student who bombs their first exam is likely to do better on the next one, closer to their normal academic level. The same is true for companies and stocks. High-flying, glamorous growth stocks that seem like they can do no wrong often have their valuations come back down to earth. And on the other side, beaten down, ugly, forgotten companies that are deeply out of favor often see their fortunes turn and their valuations recover. The Acquirer'S multiple is a systematic tool for finding these unloved companies that are statistically poised to revert to the mean. Tobias Carlisle performed extensive backtests of this strategy, going back decades. What he found was remarkable. A portfolio composed of the cheapest stocks, as measured by the Acquirer'S multiple, consistently and significantly outperformed the broader market over long stretches of time. He was essentially rediscovering what Benjamin Graham, the father of value investing, called cigar butt investing. You find a discarded cigar on the street that has one good puff left in it. It's not pretty, but that puff is free. These cheap stocks are the market's cigar butts. Now let's talk about how to actually put this into practice. This isn't about finding one magical stock and putting all your money into it. It's a quantitative and systematic portfolio approach. The power comes from diversification and discipline. First, you need a universe of stocks to choose from. This should be a broad list, something like all the stocks in the Russell 3000 index, which covers the vast majority of the US stock market. Next, for every single company in that universe, you calculate its Acquirer'S multiple. Yes, all of them. This is a numbers game. You need to calculate the enterprise value and the operating earnings for thousands of companies. Thankfully, we have computers and financial data services that can automate this process. You then rank every stock from the lowest Acquirer'S multiple, the cheapest, to the highest, the most expensive. But here comes a crucial step, and it's what separates a smart, deep value strategy from just buying junk. You don't just blindly buy the absolute lowest ranked stocks. Why? Because some companies are cheap for a very good reason. They are on the verge of bankruptcy. These are what investors call value traps. They look cheap, but they're just going to get cheaper, all the way to zero. We need to filter these out. So, after you have your ranked list of cheap stocks, you apply a few basic quality screens. You want to make sure the companies are actually profitable. You can check that their operating earnings are positive. You can screen out companies with extremely high levels of debt relative to their assets or earnings. You can look for some basic signs of financial stability. The goal isn't to find the next Google. It's just to avoid the companies that are circling the drain. You want cheap, but not fatally flawed. Once you've filtered out the riskiest candidates, you build your portfolio. You take the top 20 or 30 stocks remaining on your list, the cheapest of the reasonably healthy companies, and you invest an equal amount of money in each one. Equal weighting is important. It prevents any single stock from having an outsized impact on your results. And the final, most important step is discipline. You hold this basket of stocks for a fixed period, typically 1 year. After that year is up, you sell everything, and you repeat the entire process from scratch. You recalculate the Acquirer'S multiple for the whole market. You re-rank, you refilter for quality, and you buy the new list of the top 20 or 30 cheapest stocks. This disciplined rebalancing forces you to sell your winners that have become more expensive and replace them with new, cheap opportunities. It removes all emotion from the equation. This all sounds quite simple in theory, but I need to be honest with you. Executing this strategy in the real world is incredibly difficult from a psychological standpoint. The reason these stocks are so cheap is because the market hates them. There's a cloud of pessimism hanging over them. When you buy these companies, the news headlines will be terrible. Financial news channels will be talking about how the company is a disaster. Your friends and family might look at your portfolio and think you've lost your mind. You'll be buying stocks in industries that are out of favor, companies that have missed earnings expectations, businesses that are facing intense competition. It feels uncomfortable. It goes against our natural human instinct to follow the crowd and seek safety in popular, well-loved stocks. And this discomfort is precisely why the strategy works. The stocks are cheap because of this overwhelming pessimism. The potential for mean reversion is highest when sentiment is at its lowest. To be a successful deep value investor, you need a cast iron stomach and an unshakable belief in the process. You are making a bet that the market's short-term emotional reaction is wrong, and that over the long term, the fundamental value of the business will win out. It's like being a professional house flipper who specializes in buying the ugliest, most run-down house on a beautiful street. Everyone else sees the peeling paint and the overgrown yard. You see the solid foundation and the potential for what it could be after some work, and you're getting it at a massive discount because of its current appearance. Let's imagine a concrete, though hypothetical, example to drive this home. Let's compare two companies, Future Corp, a hot technology company, and Rusbelt Manufacturing, a classic industrial firm. Future Corp is the darling of Wall Street. Its stock price has tripled in the last 2 years. Everyone loves the story. Its PE ratio is a bit high at 30, but analysts say its growth justifies it. But when we look under the hood, we see that Future Corp has taken on billions in debt to fund its expansion. Its enterprise value is huge. When we calculate its acquirer's multiple, it comes out to a lofty 25. Now let's look at Rusbelt Manufacturing. Its stock is in the gutter. The industry is facing headwinds from foreign competition, and they just announced they are closing a factory. The news is all doom and gloom. Its PE ratio is a lowly 8. No one wants to touch it. But when we dig into its financials, we find that Rusbelt has been diligently paying down its debt for years, and now has almost none. It also has a huge pile of cash on its balance sheet from selling off some old real estate. When we calculate Rusbelt's enterprise value, we find it's actually lower than its market cap because the cash is so significant, and its operations, while not growing, are still churning out a steady, respectable profit. Its acquirer's multiple comes out to an astonishingly low 4. From a pure acquirer's perspective, Rusbelt is more than 6 times cheaper than Future Corp. This is the kind of hidden gem that the acquirer's multiple is designed to uncover. It forces you to look past the story and focus purely on the numbers. It's also worth noting that this strategy will not work every single year. There will be periods, sometimes lasting for a few years, where growth stocks and market darlings outperform everything else. During these times, holding a portfolio of ugly, cheap stocks will feel like a mistake. Your portfolio might lag the S&P 500. This is the ultimate test of your patience and discipline. The historical data shows that over full market cycles, which include both bull and bear markets, this deep value approach has provided superior returns. But you have to be willing to endure the periods of underperformance to reap the long-term rewards. So what is the grand takeaway here? The acquirer's multiple is more than just a formula. It's a philosophy. It's a shift in perspective from being a stock market speculator, chasing hot trends and narratives, to being a disciplined business analyst. It encourages you to ask the most fundamental question in investing. What is this business truly worth? And how much am I paying for its ability to generate cash? By focusing on the total cost to buy a company, its enterprise value, and the pure profitability of its operations, its operating earnings, you can cut through the noise and identify genuinely undervalued opportunities. It's a robust, evidence-backed strategy that brings investing back to its first principles. buying good businesses at a great price. It requires patience, it requires emotional fortitude, and it requires you to be a contrarian. But for those who can master its simple logic and its difficult psychology, it can be a profoundly effective way to build wealth over the long term.